Welcome to AllGen's Market Update. My name is Jason Martin. Today is June 18th, 2020. I want to bring you guys up to speed on what's been going on in the market. So first we're going to look at how a complacent market last week took a sharp decline over the fear of a potential second wave of COVID-19. Also want to look at some of the conflicting signals that we're seeing in market sentiment, and then discuss some positive economic news that came out recently, and then how we're preparing for the second half of 2020. So let's hop right in. So as you can see, here's a chart we've been referencing quite a bit recently. This is the S&P 500, and this is looking at the drop since February 20th, 2020, the big drop that happened in the pandemic. We went down 34%. And then going into last week, you had a big rally that ensued since March 23rd of 2020. Since the bottom, the market went up almost 45%. And that all happened in a matter of about 2 months. Anytime the market goes up that quickly and that much, you have the potential for a sharp decline. And it doesn't take much of a catalyst. Last week we did get a couple of catalysts that could potentially drop the market. One of them was a fear of a second wave of the coronavirus coming. There was also some social unrest, obviously, that happened at the same time. But really, any catalyst after the market made such a big rally could have dropped this market. And sure enough, the market dropped about 7% in a matter of a couple days, and it's come back a little bit since then. So volatility has come back a little bit recently. And let's take a look at anytime the market can get complacent, where it doesn't fear a market drop, that can be a recipe for a potential for the market to drop. So this is one of the market sentiment indicators that we follow quite a bit, that I've pointed out on past market updates. And what we're looking at here is it's called sentiment. It comes from a site called sentimenttrader.com, and it looks at smart money versus dumb money. And again, we don't mean to be condescending. Those are not our terms. But smart money would be more people in the know, large institutional traders, and dumb money would be kind of your average investor who doesn't do a lot of research, kind of trading off of a whim. So anytime that the dumb money, which is represented here by the red line, gets overly excited or overly optimistic, then you have the potential for a market drop. You can see prior to that happening, the big drop right before the market fell in February and March during the pandemic, you had an extreme level of optimism by the dumb money. When it gets over this dashed line, that's extreme optimism. Well, we got up there again last week, or a couple weeks ago, so right before the market dropped. So that was one thing. That particular sentiment indicator is more of a short-term indicator. But there's a conflicting signal when you look at a little bit more of long-term sentiment. And this is a survey put out by AAII, which means the American Association of Individual Investors. So this would be kind of like a sentiment of your average trader. Again, not the institutional, not the people that would be considered in the know. This would be your average investor. And so you can see about 24% of the average investors out there right now are bullish, whereas almost 48% are bearish. And if you take the difference of bearish to bullish, it's about 23% approximately more people that are bearish than are bullish. That in the long term has actually been a very bullish scenario. That when you're thinking about market sentiment, you're usually trying to do the opposite of what your average investor would do. That's how market sentiment works. So let's take a look at this one. So what this chart is looking at, same thing, but it's looking at the sentiment measured down here on the bottom. When this bottom line, which is measuring your average investors that are bullish versus the average investors that are bearish. So when this line goes below this green dashed line, it means more than 25%, or there's a lot more bearish people than bullish people. So a lot more people thinking the market's going to go down. And where we're at right now, over the last about 30 years, when we've entered into this much bearishness, according to that particular sentiment indicator, there has been 91% of the time the market has gone up within the next 1 year period. And on average, it's gone up 20% a year later. So there's been 34 times that this has happened over the last 30 years. 31 of those times were positive. There were 3 that were negative, and 3 that were negative were right in near 2008. So, anytime we look at any of these indicators, we never base all of our money management and our positioning of the portfolio based off of one indicator. But this one definitely would show a potential bullish scenario setting up for the market, which conflicts from the last one I just pointed out. So, like I said, one of the biggest concerns last week was a fear over a second wave of COVID-19. And what we're looking at here is the daily deaths in the United States. And you can see this goes back to February. You can see the daily deaths really started to ramp up in April. And it got to its highest point which was around 2,300 deaths per day on average. And you can see since that time we basically peaked kind of mid-April, and the number of deaths have declined up until recently, and they're still declining. However, this is a chart, this is a model out of the Washington State University that a lot of people follow. And up until last week, they only showed out till August 1st. Well, last week came, they updated the numbers, they went out 2 months further, and now they're showing a second wave. So that the way you read this second portion here, or this future predicted portion, is this dashed line is their prediction for daily deaths. Okay, the red line here, the big shaded area above and below, is kind of the range of the projections. On the high end, it could be as high as this much. On the low end, it could be as low as this much. So that's a concern, obviously, if you have a second wave of coronavirus that comes. Now, as you can see, through October 1st, they're predicting a lower total deaths than what they were predicting, at our peak. But it was still a concern for the market last week. Also, there's been a lot of reports, especially we live here in Orlando, Florida, but in Florida, the number of cases have spiked a lot recently. However, it's really important, as we were looking at with that last chart, that you don't just look at cases, you look at the number of deaths. Okay, let me give you a reason why that is. If you see here, and the dark blue line, this is the number of tests that the United States have been doing, over the last few months. So you can see here in March when it first started, they weren't hardly doing any tests. Then they got to doing about 100,000 tests a day in April 1st, and then right now we're up above 400,000 tests a day. So when you quadruple your number of tests, you're going to find more cases. There's a lot of symptomatic or asymptomatic cases out there that when the coronavirus first started, people were only going to the doctor and getting tested when they were really sick. Well, there's a lot of people that aren't having any symptoms, but they're being tested because they're going back to work and they're discovering some cases that probably wouldn't have gotten noticed earlier on. So this dashed line right here shows you the estimated infections, of all infections out there, even the ones that they're not catching through these tests. But my point is here, just because cases have gone up in some places, actually for the country, they've continued to go down even though we've tested more, but some places like Florida, it's gone up. The reason for that is not that all the cases are going up, it's the amount of confirmed cases that are going up because you're doing significantly more testing. So something to keep in mind. I mean, quick story, AllGen just opened up its doors last week for all of our employees to come back from working at home now to working at the office, and clients are coming back in as well, and we all had to go get tested. Now thank God when none of us have come up positive, but the point is that that's just a small sample size of AllGen and 14 people getting tested, but imagine how many other businesses out there are having all their employees getting tested as they come back to work. So you're going to discover some more cases. So this is looking at the 1918 pandemic, and kind of as we try to gauge, as we look into the end of the year and going into next year, will there be a second wave? What's the consequences of that second wave? A lot of the data that they kept in 1918 obviously is not as good as the data these days, but this is a simple chart that was made that kind of shows the first wave and then the second wave in this was basically the springtime of 1918, and then this is the fall time of 1918. So basically, spring 1918, it was kind of mild, and then the second wave, which is in the fall, it was very severe, and then the winter, it was less severe. The actual third wave was less severe. Now, there's a lot of differences between this current one and the one in 2018, but one of the similarities is they both started in the spring, and so there's a lot of predictions that we will have a second wave. The big differences between 1918 and 2020 is that there's a lot less travel. Now, World War I was ending, so a lot of the troops brought the virus back to their home countries. But these days, you have people traveling in every single country around the world, and you travel really quick. So, my personal opinion, I think there was a greater chance for this first wave to be a little more severe because of how much people traveled compared to how much travel was going on in 1918. Especially if you weren't involved in World War I in 1918, there was a lot less travel for those particular countries. So I think this first wave could be a little bit more severe than what the 1918 first wave was. Also, healthcare, obviously that has significantly improved over the last 100 years. Modeling, tracking, is significantly better in 2020 as well. I also think we will be, as a country and as a world, we're going to be better prepared for a second wave. We've already started producing a massive amount of ventilators en masse. There's more awareness of how to treat it. There's also more awareness of physical, social distancing, washing hands. We have the ability now to go to a virtual workforce really quick. We're closer to a vaccine and having more effective treatment. And I believe there's also less chance, if we do go into a second wave, of an outright shutdown of the entire economy, which is what happened in the first wave, because really what governments are understanding better now, the way this disease works, the way this virus works, it will spread, and a lot of epidemiologists are saying, to 60-70% of the world population. And you're not going to stop that. You're going to potentially slow it down, but the whole reason for the stay-at-home orders and just slowing it down and doing the different social distancing and that type of stuff is not so that you prevent the spread completely. It's so that you slow it down so that you don't overflood the hospitals. Really, where the massive amounts of deaths happen is when the hospitals get overflood. So, but if you can keep it at a point where you can continue to work, keep the economy open, and not flood the hospitals, then you have a better chance of the economy not getting hit as hard, while still, protecting people. And I think that's a little bit more what the second wave will look like, rather than an outright shutdown of the whole economy. So there has been some positive economic news recently. It's going to be hard to see in this chart right here, but this is looking at the unemployment rate. Last week there were some pretty positive numbers. A lot of people coming back to work, where the unemployment was predicted to go up even further. It got as high as about 14% as of the numbers that came out last week, which showed the numbers for May. Unemployment actually dropped unexpectedly rather than rising significantly. So that's a positive. At the same time, this is looking at the amount of people that are filing for unemployment, and you can see that's been dropping significantly. Still really high above historical numbers, but it has been coming down, potentially pointing to the worst being over with unemployment. And then a big component of the United States is consumption and retail sales. So 2/3 of our economy, almost 70% of our economy is made up of consumption, people buying things. And you can see here, so this is retail sales. Retail sales crashed, going into April, March, April, but now it had a pretty big jump this past week, and that's encouraging especially for the U.S. economy. So in summary, while short-term sentiment remains somewhat complacent, other sentiment indicators give a bullish reading over the long run. There is some positive economic news that is helping. And we are preparing. We do believe there will be a second wave of coronavirus, and we are preparing for that. We believe it's going to be different than the first wave, but we just want to let all of our clients know that we are preparing. We're doing tons of research right now to continue continue to prepare for this going forward. And in general, what we're doing is rebalancing. You know, a lot of the stocks have gone up a lot. We're going to rebalance to pull some of those stocks down. I mean, to sell off a portion of those stocks, to reduce the amount of stocks that we have. We hold a lot more defensive stocks that aren't as affected by a downward drop in the economy. We're going to continue to hold safer kind of U.S. Treasury bonds and gold. So I hope this helps. Just want to keep everyone informed. I hope that everyone stays healthy, and we wish you the best. If you haven't done so already, click here to subscribe. We frequently upload market update videos on the coronavirus, provide financial planning tips, and relevant personal finance topics on our channel.